To get a read on the housing market, most people look at home price data, and lately, they've looked encouraging. But our next guest says these data and the homes listed for sale right now miss a big part of the housing picture, one that may undermine the real estate recovery. Laurie Goodman is an analyst at Amherst Securities. She joins us now right here in the studio. Laurie, you call it the shadow inventory, the housing overhang. Let's first explain to our viewers what you're talking about.
Yes, basically there's about 7 million homeowners in the United States that are currently not paying their mortgage. Once a borrower is 30 days down, that is, they've missed one payment, the probability that they will eventually recover is only about 25%. Once they've missed two payments, the probability that they will eventually recover is around 5%. And once you're down three payments, it's about 1%. The result of that is out of 56 million homes, you have about 13.5% that are at least one payment down. And when you probability weight that, you end up with about 7 million homeowners that will eventually default.
So effectively a flood of supply that's going to come onto the market. But I do want to explain that these are not numbers that are just out there. You actually have to calculate them. You went to the Mortgage Bankers Association, First American, CoreLogic, Trulia.com, people may know that, as well as RealtyTrack to try to put all the pieces together. Is that correct?
Yes, we did. We started with the Mortgage Bankers data because that covers the entire mortgage universe. We got the delinquency numbers from there. We then applied the cure rates using data on the non-agency market from First American, CoreLogic, and got our 7 million units. We then verified the problem in terms of the overhang using Trulia, which maps in the RealtyTrack data.
And then, Laurie, I mean, we have to suppose that this is just going to get worse because there's a lot of option arms that are beginning to reset, right, at the beginning of the year?
Yeah, the option arm problem is definitely a huge problem. You've got the reason these loans default is pay shock is very, very important in terms of probability of eventual default, as is negative equity. The pay shock problem on the option arms is yet to come. The bulk of the subprime resets have already occurred. What you've got ahead of you is Alt-A, prime, and primarily option arms.
Let's bring up a chart that shows people exactly the difference between prime and subprime to illustrate what you're saying. In subprime, you've seen liquidations and defaults actually cross, whereas here's prime, right? So the defaults are beginning to come down, but the liquidations could actually get a lot higher. Is that correct? The liquidation activity?
Yes, it is. Yes, you're just beginning to see the problems in prime work their way through the pipeline, but you've got a huge number of defaults that haven't liquidated yet. You see that.
It hasn't yet got to what we see here with subprime. Let's also bring up this case example of Los Angeles, which you cite in your report to show exactly what the shadow inventory problem is. Right there it says actual listings of 43,000, but you've calculated that the red, yellow, and purple pieces of the pie are the parts that everybody is kind of missing, that they don't realize have yet to come onto the market.
Yes, and actually you'll notice that we start with notice of default here. There's actually one stage before that, and that's when the borrower simply misses a few payments, and that is not included in these numbers. So this starts with the notice of default. So if anything, this understates.
Wow. Okay, very quickly, we need to get your assessment of what this means for real estate prices.
We think real estate has a little bit further to fall. I mean, remember, this housing affordability is at a 20-year high at this point. Nonetheless, you've got this huge overhang problem, so we think it has a little bit to fall, but then you're going to have the shadow inventory is going to cast a very long shadow over a very long period of time, so the recovery is going to be...
The bottoming process could last for a long time.
Could last for a long time, yes.
Laurie, thank you very much for joining us. It's Laurie Goodman from Amherst Securities here with us in the studio.